Good morning, everybody, and welcome to this 1 hour webinar on cognitive decline and financial outcomes in retirement. Thank you very much for joining us. This is going to be the last retirement and pensions type webinar from IFS in 2025, and I'm absolutely delighted to be joined by my speakers, who you're going to see in a few minutes. First, I'm going to have Heidi Karjalainen, Senior Research Economist at IFS, who's going to talk about this new report that she has authored on this important issue. And then I'm going to be joined by Sir Steve Webb, partner at LCP. And for those who don't know, Steve is a former pensions minister. Before we kick off, I want to thank the funders of this work, which is the IFS Retirement Savings Consortium. On your screen, you see a large array of funder logos. We are grateful to each and every one of the funders who come together to support pensions and retirement research at IFS and this project in particular, without which we couldn't do all this work, and from whom we also benefit from really great comments to improve the quality of our research. So in a sec, I'll hand over to Heidi to kick off. She'll hand over to Steve, and then we'll come back to the three of us for a Q&A. And you should be able to access to write your questions and upvote the ones you think are best on the Slido link that you can see on the page that you are viewing this from. That's enough from me, and I'll hand over to Heidi now to start her presentation.
Great. Thanks very much, Jonathan. So I'm now going to go through some of the key findings from the new research that we've published today on cognitive decline and financial outcomes. So just to start with an introduction. As life expectancy gradually increases, that means that more people are living to much older ages. But this also means that much more people, or many more people, are at risk of cognitive decline because the likelihood of it increases significantly with age. We also know that navigating financial decision-making, both before and after retirement, is becoming increasingly complicated. And part of the reason for that is that we have moved away from defined benefit or final salary type pension schemes towards defined contribution pension pots. So this means that people no longer automatically get an income for life from their pension. So the implication of this is that a growing number of older people are having to make active financial decisions into advanced ages where the risk of cognitive decline is higher. So the research questions that we want to answer in this project, and what I'm going to be asking today, are what are the patterns of cognitive decline at older ages? And also, how is cognitive decline associated with changes in financial wealth later on? To our knowledge, this is the first time that this type of work has been done using English data, especially looking at the second question here. There is related work from the US that shows that wealth declines following cognitive decline. I do want to say up front that while we see while we find a similar pattern in our work of wealth declines following cognitive decline, there are still question marks around the exact mechanisms of what's driving these results. So that means that we can't say exactly for sure how worried we should be about these findings of declining wealth, but we think this is a really important first step in shedding some light to what some of the financial consequences of cognitive decline might be. And I will start by talking you through the data set that we use, as well as the measure of cognition. I'll then talk about the first question here, so how does cognition change with age? And then looking at the analysis on how cognitive decline is associated with later financial outcomes. So starting with the data and the sample. So the data that we use is the English Longitudinal Study of Aging. This is a nationally representative sample of the 50-plus population of England. And this survey follows people, the same people over time. And in most of our analysis, we follow the same people over a 20-year period from the early 2000s to 2021-23. And we focus on people who were aged 50 to 69 in 2002. So they were born between 1932 and 1952. When we're thinking about financial outcomes, we define wealth as net financial wealth. So this covers all sorts of savings. So things like money in current accounts, stocks and shares, and so on, less any financial debt. This measure does exclude housing or pensions. One of the reasons why we use this net financial wealth rather than something like housing is that we think that a more liquid asset is more likely to respond to changes to cognitive decline or changes to cognition rather than something illiquid like housing. And our main cognition score is based on a memory test. So in this survey, people are read a list of 10 words, sort of everyday words, and then they're asked to repeat as many as they can first immediately after hearing that list, and then also later on in the survey, about 5 minutes later usually. And we then add the scores from these two tests together to get this measure. To make this a little bit more concrete and interactive in a way, I can show you an example list of words from this test, so you can kind of get a sense for how well you would do in this test. So this is a list of words from a very similar study in the US. And in the real interview, people are read this list of words where they get one word every 2 seconds, and then they're asked to repeat as many as they can. I can read you the list of words. This is going to be a little bit easier probably because you can also see the list. But then at the end, I'll also see how many you can recall through the delayed test. So the list here is butter, arm, shore, letter, queen, cabin, grass, pole, ticket, engine. And then people are asked in the survey, now please tell me the words you can recall. In the actual survey, people have about 2 minutes. I will not stop my presentation for 2 minutes, but you can keep on thinking about the words that you can recall, and I'll show you the list again at the end. But when we then take the score from this test, as well as the delayed recall, where people usually get at least 1 or 2 words less, we then get this distribution of memory scores. So here we're showing individuals aged 50 to 69 in that first wave, so the first time they were interviewed. And you can see that the average score here is 11, so both the mean and median score is 11. But really key thing here is that there's quite a lot of variation in this score. So there are some other cognitive tests like, do you know what date it is? Or do you know who the prime minister is? Where most people get those right and it's a yes or no answer. But here you really get quite a lot of variation in this score. Now, we then want to understand how these average scores change with age. And to do that, we can draw age profiles, which we've adjusted to take into account potential differences in scores between generations. And this is the age profile we get, which basically shows that the average cognitive scores kind of start around 12 for those in their early 50s, remain relatively stable through individuals' 50s and early to mid 60s, but then begin to fall pretty steadily from the late 60s onwards. And then we see even steeper falls for those in their 80s. So essentially, the pattern here is that you have quite a stable level of cognition for those in their 50s, early 60s, but the score then falls by about a third between people's early 60s and late 80s, but really most of that decline comes after the late 70s. Now, while it's interesting to think about this average score, what's likely to matter most for financial decision making is reaching a level of low cognition rather than decline itself. So in order to look at this, we define as low cognition having a score of less than 7 in a memory test. So this is the same memory test where the maximum score was 20. Having a score of less than 7 means that you're in the bottom 3% of those aged 50 to 59, so basically this does indicate quite a low level of cognition. But we can then look at a similar age profile, but now looking at what is the prevalence of having this low memory score at different ages. And you can see here that, as I mentioned, for people in their 50s, less than 5% of people have a score of less than 7. But then the prevalence of this starts rising. And it starts rising particularly rapidly for those from their mid-70s onwards. So for someone in their late 70s, the prevalence is about 14%. And then for someone in their late 80s, it's over 40%. Now, we can also look at this, how this pattern differs between different groups. And here I'm going to be showing differences by education. So again, showing the same prevalence of low cognition, age profile, but splitting the sample into those with no qualifications, those with A and O levels or equivalent, and then those with degree or other higher education. And you can see that those with less educational qualifications tend to have a higher prevalence of this low cognition score throughout, as we might expect. And we really see those rapid increases in the prevalence among that group. But it's also clear from this picture that even among those more highly educated groups, so those with degrees, those with A and O levels, even among those groups, the prevalence of low cognition reaches over 40% by the time people are in their late 80s. So even having these educational qualifications isn't a characteristic that protects you from the effects of cognitive decline at older ages. Now, moving on to thinking about cognition and how that relates to financial outcomes. So what we're going to be doing in this part of the analysis is we're going to be comparing trajectories of financial wealth for people who do and do not experience cognitive decline. And we do this with a regression model, so that allows us to basically compare similar people in terms of their observed characteristics, where some of them do and some of them don't experience cognitive decline. We control for time to take into account kind of time trends in wealth and cognition, but then we also control for demographic characteristics, so sex, age, education, but also health. So do your health conditions limit the daily activities you can do, like feeding yourself, bathing yourself? We also have baseline characteristics, in particular things around wealth in the first time we observe the respondent, and also partner characteristics were relevant. And essentially what we're doing here is we think about how financial wealth changes before and after the first point, that the respondent has low cognition, and then relate that to those who did not experience cognitive decline. And the measure that we're using here is that as the first point, that respondent has low cognition, is that score of less than 7. Now, we have tried a number of different definitions using our memory tests, so different thresholds, having an average score of less than 7, and so on. The big picture is that the results all look very similar. But before we get to the results, I do want to say that we have to be, when we're interpreting the results, we have to be a bit careful, especially around causal claims. So we know that many things might be changing at the same time as cognitive decline happens. People's lives are changing a lot at this point. We do control for a number of factors, such as these functional limitations that I mentioned as a proxy for health, things like partners' cognitive decline. But we cannot rule out that there could be other things that we don't observe that could contribute to these changes in wealth, and in addition to cognitive decline. So essentially, not all of the change in wealth is necessarily just due to the change in cognition. But we do think that these are a good estimate of the relationship between cognitive decline and wealth, and can provide interesting evidence of this relationship. So I'll now start by showing some results. So in this chart, I'm going to be showing how people's financial wealth changes in the years before and after the first signs of memory decline or cognitive decline, comparing those who did and didn't experience that. So these dots here refer to the period before we observe low cognition among either of the groups. And the black dots are the kind of estimated difference in wealth between these two groups, those who experienced cognitive decline and those who didn't. And then these bars show the confidence intervals, for 95% confidence intervals around those estimates. And we can see that in the years leading up to the first signs of low cognition, the wealth levels among those who did and did not experience cognitive decline look pretty similar. So the estimates are relatively close to zero and not statistically significant from zero. Then after the point of cognitive decline, immediately after, that still seems to be the case. We don't see a huge change every time. But the estimates move around a bit, but we do have this gradually declining trend here. And basically by year 8 and 10, after the first time we record low cognition, those who experienced it have wealth that's around £30,000 less than those who didn't. And that's relative to an average level of wealth of around £105,000 among these groups. So essentially, the trajectories of wealth for those who experience cognitive decline compared to those who didn't are quite similar beforehand, or very similar beforehand, and immediately after the first time we observe low cognition. But we do see this gradual decline, and then the substantial gaps appear 8 to 10 years later. Now, we've then also looked at heterogeneity. So how do these results differ for different groups? First, we find that for those who had a higher level of wealth in the first wave, the first time we interviewed this group, they experienced larger falls in their wealth. So you can see that here. The pattern kind of looks quite similar to the previous chart, but you can now see that the the point estimates here in year 8 and 10 are much larger. So basically, we find that these results for those with higher levels of wealth are much more larger in magnitude. Whereas if we're looking at people who had a lower level of wealth at the start, we see much smaller declines, and actually none of these are statistically significant. Now, of course, some of this will be mechanical. In order to see a larger fall in wealth, in pound terms, you have to have more wealth. But this is also true when we look at proportional changes in wealth. So those who are in the top half in terms of their wealth at the start see larger reductions in wealth, both in absolute but also proportional terms. Now, there are different reasons why this could be. Some evidence from the US suggests that this could be because those with more wealth are more likely to hold risky assets like investments, stocks, and shares, which then means that they're more exposed to the potential effects of making financial mistakes. Now, we've also then looked at some other types of heterogeneity in these responses and the results to try and understand the mechanisms for why we see these patterns. And I'll briefly talk through a couple of these, and then there are others in the reports as well. But first of all, we find that the results are not driven by those receiving formal care. So even if we only look at people who say they've not received formal care, we still see that pattern of declining wealth. Now, the caveat here is that we don't really very well observe people moving into care homes. So this would be excluding any very significant residential social care costs. But this does suggest that at least excluding those, we don't see these results being driven by that formal care spending. You might also think that when people experience cognitive decline, they just start giving money to their family, friends, and charity. But there are questions around this in ELSA, so people are asked about transfers they've made to other people. We don't find that these could explain the changes that we observe. They're much smaller in magnitude, and we actually also find that these fall after people experience low cognition. So essentially, you can sort of see here that what we've managed to do is rule out a couple of potential explanations for the patterns that we find. But it's also fair to say that the exact mechanism behind the decline of in net financial wealth here is not yet clear. So it means that it's not really clear just how worried we should be about these results. These reductions could actually be a sensible response to worsening cognition. So people might realize that they're experiencing low cognition. They might think that that means that they, for example, have a lower life expectancy, and then they're going to spend their more wealth more quickly. But it could also be that that people are more likely to make financial mistakes, and there is evidence of this from other countries that finds that the likelihood of financial mistakes increases with age. And of course, if it is around financial mistakes that are leading to these results, then we might want to think of some kind of intervention to protect people. So, related to that, we can then think about the policy implications of this work. So the results here suggest that there is potential for policy to do more to protect financial security in later life. And one of the reasons why this is increasingly true going forwards and increasingly important is the fact that fewer people now have a guaranteed income stream in retirement. So as I mentioned, we've seen this move away from defined benefit to defined contribution pensions, which means that people hold a lot more of their wealth in these liquid pots. So both in terms of their financial wealth, but also defined contribution pots. And we think that that there could be more that could be done to nudge people towards purchasing annuities or related products that actually provide some guaranteed income streams in retirement. And in the next few years, new regulations in the UK will require pension funds to provide a default retirement income product to their members. And we think that the cognitive decline is something that the design of these products should be taking into account. In particular, these flex then fixed type products, where people essentially initially have flexible access to their pension or part of their pension pot, but then commit to purchasing an annuity at a later age, say age 75 or 80, that could help make financial decisions in older age easier because you've made some of those decisions earlier on before the risk of cognitive decline is increased. Of course, other types of early planning can also help mitigate these risks. So things like putting in place a power of attorney. But really there, it's a role for individuals and families to thinking ahead as well. Now, just to conclude, so we find in this research that the risk of cognitive decline is high at advanced ages, and this is true across different groups. I showed you the differences across educational groups here, and we found that even those with degrees and higher education, a very significant minority of them by their late 80s are experiencing cognitive decline. We also find that those experiencing low cognition have lower levels of wealth in later years, although this difference does appear quite gradually rather than immediately. These findings, or our other findings, also suggest that the higher level of wealth exposes people to larger declines in wealth. This is even before any significant social care costs are incurred, but this could have to do with things like holdings in risky assets. But because we find that the effects here emerge gradually rather than sharply, that indicates that there is a window of opportunity for policymakers, for pension funds, for individuals and their families to try and put in place these protections. So we really do think that, given that we don't see immediate declines in wealth, that does indicate that there is some people have a bit of time to put in place these protections and interventions to help prepare people for the potential effects of cognitive decline in retirement. So that's it for me, but I will bring up the word list again. So I would now kind of ask you to see how many words you can recall from the list that I gave you at the start. Now, this is going to be more difficult than it would have been in the actual survey because I've been talking for about 15, 20 minutes rather than 5 minutes like it would be in the survey. Also, I am talking rather than giving you time to think about that. But I will now just show the list so that you can figure out how many words you got or could recall. So here's the list of words that I read at the start. So that is now actually it from me. And I will hand over to Steve Webb for a response.
Thank you very much, Heidi, and good morning, everybody. Great to be associated with this research. We were part of the consortium that helped to fund it, and I think it's extremely valuable and presented admirably clearly. So thank you for that, Heidi. A few thoughts from me, most of which actually reinforce, I think, the research. I've had the opportunity to read the full report, and there are a few things in that I wanted to bring out. I suppose the first thing that strikes me is that, a slightly gloomy thing to say at the start of the webinar, really, but is the situation is probably significantly worse than the research suggests. And the reason I say that is twofold, really. One is that inevitably research like this is based on a survey. It's based on a sample survey, a voluntary survey. And it seems pretty obvious that you would expect people with significantly low levels of cognitive ability to be less likely to respond to a survey in the first place. So it may well be that there's a group of people for whom all of these issues are more acute who never get into the survey. Now, the survey does what it can to deal with that. For example, in some cases, you can have proxy answers. So someone gives information on behalf of someone else, but you can't do cognitive ability on a proxy basis. So I strongly suspect that the simple fact that this is based on a survey excludes some of the people potentially most adversely affected. So I think in many ways, that means we should take all of these findings even more seriously. A link point is, as I understand it, to avoid various biases about people with different characteristics dying at different rates, the research is based on people who are alive for the entire 20 years. And if that's correct in my understanding, then again, people who have serious health problems such as dementia, Alzheimer's, who die prematurely as a result, are not in the sample. And I checked this morning, and dementia and Alzheimer's together are the #1 cause of death in Britain. So it's quite likely, I think, that the research based on people who live for the full 20 years is excluding, for good reason, good methodological reasons, but he's excluding people who suffer severe cognitive decline associated with dementia and who die prematurely. So again, another reason why we should be particularly concerned, I think, about what the paper has found. Now, the big policy implication of all of that, which Heidi touched on, is at the moment, the whole pensions industry is designing post-retirement default income solutions. And I'm a big fan of the idea of flex first, fix later, a sort of flexible early phase, as kind of drawdowny phase, and then an annuity later. But there is a problem. There is an institutional problem, which I don't think we fixed and which is very relevant to this paper, which is, as things stand, it's very difficult to actually commit someone at, say, 65 to an annuity at 80. What these products actually do is tell people that that's the plan, that they'll have a drawdown phase. The aim is to run the drawdown pot to 0 at 80 or whatever the age is, and that then they'll move on to an annuity. But as things stand, you then have to sell people an annuity at 80. You can't sell them a deferred annuity at 65 as an individual retail product. And that worries me a lot, given what we've seen in this research. Because, of course, what do you do when you sell people an annuity? Well, the provider has to nudge people to the open market options. So they're meant to look at the best buy from other providers. They have to make choices about, do they want an index-linked annuity, some protection against inflation? They want some joint life, something for a widow or widower. Do they want a guarantee period? So if they die early, they still get a payout. And we are, as far as I can see, still going to expect people of 80 to make these choices. And I think what this research shows today is that's not a great place to be. That's not a good thing to have to rely on. So the sooner, in my view, FCA rules are changed to allow providers to actually sell people an annuity properly at, say, at the start of the product, at the flex period, and then it simply cuts in at 80, perhaps with an opt-out, but to do all the heavy lifting early I think we have a problem, and I don't currently think that that's resolved. Third thought, and then one possible explanation for some of the results, is something that comes out in the report, is that to get into the sample of people with low cognitive ability, you have to have this low score. But for the graduates and the generally better educated people, their initial score is typically higher. So actually, for a graduate to appear in these tables, they've suffered more substantial cognitive decline than the less educated people. So in many ways, it's more shocking to see the graduates in the table. And the fact that when Heidi showed the slide by different levels of education, you get this steep rise during the 80s and particularly late 80s for graduates as well, shows just how substantial the decline has been. So they are, I'm not sure this is the right phrase, almost different people, but that something quite substantial has gone on for these people. So bluntly, higher education and education generally is not an insulator against cognitive decline. That's very clear from this research. And those of us who think, well, it won't ever happen to me, might want to just reflect that actually it could easily happen to you based on this research. And therefore, things like setting up power of attorney and all of that become all the more important. And then just one final observation about this decline in non-pension financial wealth after cognitive decline kicks in. And I found myself saying the word scams. As a member of parliament back in the day, I would sometimes come across people, often elderly people, who'd got on lists of people who are susceptible to being scammed, and they get bundles of stuff through the post, send £20 to claim your free prize draw winnings, the notorious emails that we all get. And that's changed a lot. I mean, there are television programs, think about Scam Busters and so on, where, somebody rings the perhaps elderly person, pretends to be from Microsoft and gets them to put their computer on and type things in and take control of the computer and raid their banks, or pretends to be from the bank and gets passwords and all that kind of stuff. And I do wonder, I don't have any evidence for this, but I do wonder if people who've suffered cognitive decline, have low levels of cognitive ability, particularly as they get older, are more susceptible to those kind of things. And I suspect that we massively underreport the scale of all of that, because frankly, nobody really wants to admit to having been scammed. And indeed, people don't, when you see Scam Busters on the television, people often are less sure who to trust, the TV crew or the person on the phone, because the person on the phone sounded quite plausible. So it's hard to say how important that is, but I do wonder whether a bit of the decline in people's financial wealth is partly a set of people who actually get scammed, who open their bank balances, their computers and so on, money is taken out, and that's potentially part of the story. That's speculation, but I do wonder whether, in terms of policy responses, that's something we need to think about more. So I hope that's helpful. A few thoughts there, Jonathan. And with that, I'll pass back to you so that we can take some questions and reactions.
Thank you, Steve. Sorry, I was having problems with my mouse clicking to get me back on screen. But thank you, Steve, and thank you. Hey, I think that was really interesting. And actually, some of the questions I was going to ask Steve myself have already come up into the Slido. So I'm going to go straight to Slido. We've got about 25 minutes before we need to wrap up. I'll start, if it's okay, with actually the most popularly voted question. I think I'll put this to Heidi about what do we know in a bit more detail about the types of people who do and do not experience kind of, I think, probably significant cognitive decline, I'd say. Is it wealthy or less wealthy people? What about people who retire early or late? That's the kind of things that the questioner asked. Maybe you can add anything else you know about this.
Yeah, no, it's a great question. So we did look at this in the report, where basically we're again taking those observed characteristics that I listed and looking at which one of those is associated with a higher likelihood of experiencing cognitive decline. And we find that, as you might expect, people who are older, more likely to begin with, are more likely to experience cognitive decline. We also know that people with more education, as well as women, are less likely to experience this cognitive decline. The patterns around wealth, when you put in kind of all of these different characteristics in these regression models at the same time, actually some of the patterns between different wealth groups sort of disappear a little bit. And, we think that some of that is captured by things like actually the kind of educational differences, for example. But we do find that, for example, renters compared to those who own outright are more likely to experience cognitive decline. So it does tend to be a little bit the case that, or to some extent the case that people with lower levels of wealth, even when you take into account all of these things, are more likely to experience cognitive decline. Now, the question around retirement is a really interesting one, which we didn't look into specifically here, whether kind of later retirement is good or bad or for your cognition. I know Jonathan has some work into this that came out very recently that shows that there are some people who can benefit from working later in terms of keeping a higher level of cognition for longer and kind of delaying any onsets of declines. But the evidence is quite mixed there because it sort of depends on the types of people who are affected and who are, or types of work that people do as well.
Yeah, I mean, it's a kind of use it or lose it kind of hypothesis there. It's not only our paper, there are others. It's not unanimous, but there certainly are papers that show, people who are able to kind of continue working in their 60s, for example, that work kind of helps maintain their cognitive health. I think it's also worth saying, just because as we are on this kind of what's the risk factors here, and I'm looking down at the other questions asking whether those differences by education are causal. Well, I don't know whether the entire difference there is causal or reflective of other things. We do know that major educational reforms that pushed up education, pushed up school leaving ages, for example, in the 40s. You can track those cohorts all the way through their lives and see that in their 70s, for example, people who got a little bit more education because of the higher school leaving age have higher levels of cognition. So it's not just a kind of, these are kind of slightly wealthier people who happen to be higher educated. It seems like there's evidence that actually education kind of actually prevents some of this, even though it's a very long life course that people have. Okay, the next I turn back to Slido and the new one the next one really wants Steve to ask, why can't people buy at 65 an annuity that will only kick in? You mentioned the FCA, so kick in at age 80, so they don't have to make a decision. You mentioned the FCA. Why are they preventing this? Somebody really wants your answer, Steve.
Yeah, I mean, so if you think about the days when people were forced to buy annuities, the big worry was that they bought an annuity from the pension company they'd saved with, inertia and all sorts of reasons led them to do that. So gradually the FCA got quite stroppy about this and forced people to require people to shop around and all of that, and that has kind of gone up. But the product that you buy generally at the moment is an immediate annuity. That is, you go on an annuity comparison site, you go and read the newspapers and so on. The quote you get, it's not that there could not be a product that is an annuity in 15 years' time, but that's not currently what you buy. Now, you could say, well, why won't the insurance company sell you a deferred annuity? Of course, one of the problems is nobody knows what the annuity rate is going to be in 15 years' time. So that raises some quite tricky issues. So do you guarantee it? Do you, as the provider, say, look, we set the sustainable drawdown rate, so the drawdown pot runs to zero at 80, and then an annuity kicks in that keeps the figure exactly the same, and we, that's what we sell you 15 years notice. But of course, that's an expensive product to put solvency aside for. Because if annuity rates collapse and you've promised somebody a high annuity rate, you've got to have a lot of money aside just in case that's what you have to pay out. So at the moment, that's not how it works. These flex first, fix later products do not commit you at 65 to an annuity at 80. They tell you that we'll sell you an annuity at 80, but they don't sell you an annuity at 65. And until we can fix that, Um, I think we really do bang into all of the problems you're setting out, and I don't think yet we fixed that. Now, the fact that we've got a bit of time is good, but it does need fixing.
Okay, thank you for some of the kind of the depths of some of these kind of regulatory issues that interact with the kind of experiences that people and their families are having. Um, Speaking of families, there's a question somewhere in here that uh, uh, talks about well, not only scams, which um, Steve, you mentioned, but older people being exploited even by members of their own families. Hayley, you raised, I think reasonably, the idea that, maybe children can help their much older parents, get their house in order. People at younger ages who haven't experienced this decline. But the questioner kind of points to maybe not every family has that kind of supportive system and whether we face risks here. I don't know whether either of you have any thoughts about how reliant older people might be on their family members and where that can, present risks.
Yeah, well, I mean, I think it's definitely so. One of the things that we kind of hypothesized to begin with was, well, maybe having children, they can help you with your finances. You might see smaller declines in your wealth. We do actually see that the results. We see kind of larger declines in wealth for people who have children. Now, in this, especially within these generations, it's quite. It's a vast majority of people who have children, so the kind of results are a little bit imprecise. So I wouldn't read into them too much, but we do that. At least we didn't get kind of confirmation for that that kind of analysis or that kind of hypothesis there that the children would be protecting their parents. So again, that there could be. It could be that there is something like exploitation going on, but again, based on this survey data, I wouldn't make those conclusions necessarily. But it's very much related to that point around kind of fraud and scams and things that can come from sort of more external factors and people being subject to scams. But it could also be that there are some sort of carers and things, people who should be the protecting older people that could be taking advantage of their vulnerability. But unfortunately, that's not something that we can really answer with this survey data necessarily.
I think that's right, Heidi, and you do obviously hear horror stories, don't you, occasionally about, the carer who exploited the person they were looking after. One hopes that they're exceptional, but just on Jonathan's point about the kids helping the parents and so on, I think there's a real challenge in relying at all on that, in the sense that having been a parent, by the time you get to your 60s and 70s, you've been in control. You've been the one teaching your children about money. And to somehow allow that, so many people of that kind of age would just not want their kids knowing anything about their finances. The idea that the kids would keep an eye on what's going out of the bank account and what they're spending the money, I don't think it's going to happen by and large. And I think therefore it tends only to be spotted by kids when it becomes extreme. Mom or dad doesn't go out the house anymore, doesn't seem to put the heating on, doesn't, by which time it's all kind of far too late, really. So that's why I think all the stuff about, power of attorney, I've just done power of attorney for myself, for my kids who are looking forward to controlling my bank account. It slightly feels they've been doing that for the last 20 years, but it's a blooming pain. It's actually a really difficult process to go, and I actually did the health and welfare one and mucked it up and had to resubmit it. So it is actually difficult to do. Now, there's a good reason it's difficult to do. We don't just want anybody to be able to control someone else's money, but I wonder whether it's just too difficult. Given the issues that you're raising today, whether we should just make it a bit easier for people who, in good faith, want to allow their children and trusted ones to have more involvement in their finances. Is there a halfway house or something? Do we need to involve financial institutions, banks and such like, who inevitably, you ring the bank, and if you are not the customer, incredibly difficult to get anything done. So, so I think there might be things you could do short of full-blown power of attorney, just with working with financial institutions. And AI ought to come into this, didn't it, really? AI ought to be pretty good at spotting strange things going on in accounts. I'm sure it does already, but it feels to me like there's a lot more potential there.
Yeah, and I mean, I think there's lots interesting there. Just as a kind of additional thing is just, there's a huge heterogeneity in how much, you know, much older people see of their children, are largely related to geography.
Yeah.
Very large numbers of people live within about 5 miles of their parents, even at older ages. But many people live across the country or even in other countries as well. And so that's another reason that relying on this is a lot harder if you're only seeing each other every couple of weeks or much or even much less. Okay, there's various comments here, Heidi, about gender, about either the declines for women and men, or the extent to which they suffer from cognitive decline. Unless I missed it in your slides, I don't think you mentioned gender.
Yeah, no, I didn't. So basically, I think that one of the questions here is referring to an appendix chart. I like the fact that someone's already got to the appendix of our report. So essentially, what we are showing there is that the prevalence of having this low cognition score is higher among men than it is among women. So basically, women have tend to have sort of higher levels of cognition. Now, this is in line with some other research that we've seen, and I think there are a couple of things that play into that. I think so. First of all, the cognition test that we're looking at here is the kind of memory test, and there's some evidence from that suggests that maybe women to do better on that test, whereas you might have some other tests like sort of visual spatial ones where men tend to do a bit better. So, it could be to some extent around the test, but I think the much more important factor here is that we also know that men tend to have in terms of their health, tend to have more health conditions and also lower life expectancy. So women, and we know that cognition and health are related in many ways. So I think it's probably just reflecting these gender differences in that sense. So that's basically when we're thinking about the prevalence of low cognition, or that's higher among men. When we've then looked at the results, the kind of so basically doing this analysis on what happens to financial wealth later on, when we've done that, splitting men and women, we don't really find any systematic differences. So the patterns look very similar across both men and women. So I think that's probably all I have to say about gender in terms of what we've done in the reports.
Thank you. That's I always I also agree with Hayley that getting people into the appendices of our reports is exactly where you want to be. All the charts that we wanted to add, but felt we couldn't clutter up the main text with. There's it's an interesting point here, a bit lower down, that starts to think about the kind of other things that people might be doing with their wealth. If they face cognitive decline, and whether that can help. So I don't know, Hayley, exactly how much you'll be able to kind of draw on this from the research that you've done, but maybe broader. The question is it possible that people with cognitive decline don't do things like downsize, withdraw home equity, bringing or actively draw down pension wealth, which would bring that wealth into the scope of your study? If they're not doing it, is it outside your wealth definition? So maybe let's come to Hayley first, and then Steve can chip in too, because I think it is a good question. We've talked about scams, we've talked about mistakes. Maybe these things are less worrying, and what do we know there?
Yeah. Yeah, no, it's a really interesting point. It's not something that we've looked into specifically. I guess with something like withdrawing home equity, even downsizing, we do know from ELSA, from the same data set from other analysis, that they're relatively uncommon. So people, whether they are experiencing cognitive decline or not, people are just not very likely to downsize or draw home equity. The question around kind of pension pots and especially defined contribution pension pots and how cognitive decline might affect decision making there. Now, that's obviously one of the kind of motivating questions of our research, because we want to think about the future, and many more people are going to have these large defined contribution pension pots, which are in many ways very similar to just having financial assets, these kind of liquid assets. But, among this group of people that we're looking at, because they were kind of in their 50s and 60s in the early 2000s, they're still less likely to have defined contribution wealth, more likely to have defined benefit wealth. And even if they do have these kind of pension pots, they tend to be a bit smaller. So I think that's something that it might be more difficult for us to see looking into the past, and that's why we're kind of having to extrapolate some of these results from looking at net financial wealth into, okay, how might people then use up their, or what might happen to pension pots as well. But of course, it could be that those differ as well. But that's kind of, it's a really interesting question. I think we should think about to what extent we can look into that more.
Steve, I'm sure you have thoughts here.
Yeah, I suppose I wondered about less big things than equity release and downsizing. I wondered about just general, what you might loosely call money saving behavior. There's a whole industry of Martin Lewis and all the rest of it, of, shopping around for the best deals, getting discounts, all the rest of it. And there must come a point in time when you're just too tired and you just can't be bothered, or you're not able to. And each individual transaction, saving 50 quid on your home insurance may not matter, but your research shows that, you don't really see this difference after 1 or 2 years. You see it after 6, 7, 8, well, 8 to 10 years, in fact. And maybe just a whole bunch of just not being as financially savvy adds up. You could imagine it adding up to, I don't know whether it would add up to tens of thousands, but you could imagine it adding up to thousands over a decade.
Yes, indeed. I mean, I think any one of us who's rung up our broadband provider and pretended that we want to leave because we don't really want to leave, but if we pretend we want to leave, then we can, get 15 quid off a month or something, and can totally imagine how that isn't the kind of behavior that people at older ages do. As we draw a little bit closer to the end, I want to try to combine a couple of questions that I think are just about combinable. James Kirkup has a question on, do the kind of inability of to have these kind of pre-commitment devices. He says, doesn't it show we need a wider overhaul of the law? And kind of then thinking, I think that, thinking about the structures of decision making or policy making, somebody that I can't find now kind of challenges as, is there really such a large window for intervention? Even if the declines in wealth are quite gradual, maybe that's being a little bit what do you call it, overconfident about these issues. So I think one's there kind of pushing us on the law, another pushing us, are we being a bit overconfident about these issues? And that, I guess, comes back to Steve's initial remarks about, if anything, you think that these problems are worse than that which the kind of analysis show. I don't know if either of you have anything you can shed light on there, or any thoughts on either of those issues.
Perhaps if I chip in and leave Heidi the last word would be appropriate. Yeah, so just to flesh out what I'm saying about this kind of advanced commitment to say an annuity at 80, what I have in mind is as follows. As things stand, you get to 80 and you have to go through the entire sales process, give people all the options as if they never thought about it before. What I think you could do is when you sell the Flex First, Fix Later product in your 60s, you do all of the decision making then. You decide you want to have the annuity from the provider. You decide if you want something for a widow or widower. You decide if you want inflation protection. You decide if you want a guarantee. There's an opt-out on all of this stuff, but we know the power of inertia and defaults. So do all the FCA regulated proper stuff, make sure people are making well-informed decisions at a point in their lives when they're best able to do so. And then at 80, it's almost an inevitable progression. And then all the FCA rules don't really apply then because you've done all the FCA stuff at 65. That's the kind of thing I had in mind. And I think that's doable. It's not, we've never really had, it feels wrong to say that you lock yourself into an annuity with the people you've had your product with, and surely that's not good for people. But asking 80-year-olds to make these choices isn't good for people either. So I think, we need to regulate for a second best world, and often we regulate for a first best world.
Yeah, no,
Heidi, any final thoughts?
Yeah, no, that's really interesting. I think, from the regulatory perspective as well, it would be interesting to understand more about kind of what other countries are doing where things like products like deferred annuities might be available. But when it comes to this idea around, do we really think that we have a big window of opportunity? Now, of course, the results show that from the first time that you reach this kind of low cognition score, there's still time from that point in time. Now, of course, that's we're not saying that that's a diagnosis of dementia or anything like that. So in a way, there's definitely less time from actual kind of diagnosis of severe cognitive decline. But I think we wanted this not to just be doom and gloom. We wanted to have a bit of a positive note here as well. That if you're someone who is, I think it's quite a natural point for people to think about these things and their retirement finances, for example, at the point of retirement. And so if you're someone who's retiring in their, say, mid 60s or late 60s, that's based on this analysis, both given that the prevalence of cognitive decline at that point is still pretty low, and also the fact that even if when that does set, we do see the onset of cognitive decline, it takes quite a while for that to then show up in any changes in financial wealth. So that suggests that actually for example, that point when you're accessing your pension for the first time, when you're retiring, thinking about retirement finances, that could be a really good point where to also put in place these protections for later on for a cognitive decline. So I think that's kind of what we mean by this window of opportunity. But yeah. But obviously, the kind of earlier the better. People are thinking about this. Definitely.
Sounds like you're relatively you like the idea broadly of without trying to pin you down too much of lots of people making decisions earlier and then not having to remake them again as essentially as Steve said. I'm going to just pick up and have a last word about evidence here because I think you talking about other countries is useful here. Australia, lots of people have lots of big private pensions. People don't tend to buy annuities, often take out kind of minimum amounts. I think we could probably learn a lot from there. In the United States, an enormous country with a lot of unannuitized wealth as well. So I think it is down to people like us, but also more generally to think about what do we learn from other countries and draw parallels to the situation here. We don't just need to learn about people in the UK or England. On that note, we basically came to time. Thank you so much to Hayley for presenting your new research. Thank you very much to Steve for bringing additional insight and commentary. Really value your time today. Also value every member of the IFS Retirement Savings Consortium for funding and supporting this research. Without those members, we wouldn't be able to do this and have this big program of work that we have at IFS on retirement and pensions. So that's all from us. Look out for us in the new year for more work in this area. And thank you very much for joining us today.